You're listening to Simply Put, a podcast from FHN Financial. I'm your host, Will Compernal. Even after the Fed stopped raising rates in July of 2023, there were fears that higher interest rates and lower property valuations for commercial real estate could lead to wider distress in the financial system. Although CRE has managed to avoid the dourest predictions from a year ago, property owners and lenders are still adjusting to the post-pandemic shift in how people work and live. On today's episode, we talk with Joey Kline, Executive Vice President at Jones Lang LaSalle, about the status of CRE after more than 2 years into the Fed's tightening cycle, how hybrid work is changing office environments, and what areas could perform best in the post-pandemic economy. Stay tuned. Coming up soon, our interview with Joey Kline, but first, a quick market update. The Fed left interest rates unchanged at its meeting last week, as expected. The policy statement and press conference did not tee up a September rate cut as forcefully as markets were expecting, but Treasuries rallied from Powell's comments that a cut next month would be appropriate if inflation evolved as expected. 2 days later, the unemployment rate rose 0.2 of a percentage point in July, from 4.1% to 4.3%, and payrolls grew much less than expected. The rapid labor market deterioration captured in the report gave bonds some solidly bullish momentum, keying on the FOMC statement's language that said it was acutely aware of the risks to the full employment side of its dual mandate. Market volatility spiked at the beginning of this week, starting with significant sell-off in the Japanese stock market. The yen had strengthened late last week after the Bank of Japan raised its policy rate from 0.1% to 0.25%, leaving many investors to unwind their carry trades by selling off Japanese stocks. The anxiety and uncertainty led to safe haven treasury trades, pushing yields on 2s down to 3.65% and 10s to 3.69%, briefly uninverting the curve for the first time in more than 2 years. Financial markets settled down a few days later, and Treasury yields have returned close to where they were before last Friday's employment report. Fed funds futures are currently showing expectations for just over 100 basis points of Fed easing by the end of this year. Also last week, the Treasury's quarterly refunding announced no change in auction sizes for its coupon securities over the next 3 months. The Treasury had telegraphed these plans 3 months ago, so the announcement was largely unsurprising. What was more surprising was the announcement's prediction that auction sizes were unlikely to change for at least a few quarters. This should keep some downward pressure on long-term yields, even as federal deficits continue to grow. Vice President Kamala Harris consolidated support within the Democratic Party, becoming the party's de facto nominee for president with less than 3 months before the November 5th elections. Harris also chose Minnesota Governor Tim Walz this week as the VP on her ticket. That's all for the market update this time. Now, our interview with Joey Kline. Our guest today is Joey Kline, Executive Vice President at Jones Lang LaSalle. Joey, thanks for coming on the podcast.
Sure, Will, good to talk to you.
Our topic today is commercial real estate and how the post-pandemic economy will change the ways we work and live. So, starting things off with commercial real estate, CRE, I feel like concerns about it started to pick up steam in the wake of the regional banking crisis in March of last year. There was this fear that office space with lower property valuations was going to combine with a big wall of debt that needed to be refinanced at higher rates, and there would be a wave of failed payments that would cause contagion in the financial system. It's July 2024. Interest rates have not gone down at all. Joey, where do things stand now with all of those CRE worries? Are we in the clear? Were the issues isolated? And where were the biggest areas of distress?
All right, so executive summary, I think that it becoming a widespread contagion is an overblown fear. However, it's not a nothing issue. I don't think that it's going to get to the point where it truly is something that takes down a regional bank. But in terms of the asset level health of a lot of these office buildings throughout the country, it has become a part of the broker vocabulary like never before. The capital stock, look, I'm not implying the capital stack of a building never mattered. Obviously, it always mattered. but it was never something that was in question, right? Never did brokers like me feel the need to, in a LOI, have the landlord confirm that the terms that they were offering had been approved by the lender. It just was never even a thought. So lenders and CMBS debt have come into play in leasing deals like never before. And there are, in our estimate, and when I say our, I mean JLL Research, our estimate is that there are 25 to 30% of the office building stock of this country that is simply functionally obsolete. And there already are, buildings that are trading hands for maybe not pennies on the dollar, but certainly dimes on the dollar. And that's going to have a really big impact into these outstanding loan obligations. Is it going to topple the banks? I don't think so. But it's going to create individual landlord stress, as well as incredible buying opportunities in ways that we haven't seen, I think, since 09 or 10.
Where do you think the biggest areas of distress have been? I think we had a guest on about a year ago talking about CRE when the kind of environment was still very preliminary and people could better list the kinds of fears that they had rather than kind of high quality predictions. So at this point, what have we seen for the types of CRE that have had the most distress, or even just the physical geography?
I don't think that you can pinpoint it to one physical geography. Now, look, there are certainly markets in which leasing is more robust than others. One of the more amazing items that I've read recently is that the AT&T building in downtown St. Louis, which is the tallest building in St. Louis, sold for $4 million. $4 million for a 45, 50-story high-rise office building. That is shocking. And that is a very specific indicator of the health of the St. Louis leasing market, right? So that's very different from what is happening in, call it, a Charlotte, and Nashville, Atlanta. So leasing markets are not created equal, but it's not like there is one or two specific markets where the majority of the debt is concentrated. In terms of the type of assets, it can be urban or suburban assets. I know it when I see it. And that's kind of how I would talk about the type of office buildings that are really in the most trouble. It's the 4 to 6 story office building in suburbia surrounded by a parking lot that looks just the same as the other 10 on the same exit and the next 10 on the next exit. It's the urban office building that hasn't been updated since the 80s or the 90s, that just doesn't have modern amenities or a reason to attract people to come in. It's one of those things that you can just feel as you walk through it, that it's just kind of blah, for lack of a better term. And again, we think that that's probably a good 20% of office buildings. Some of them can be saved with are in incredible locations and can be saved with just a killer rehab. And some of them, there's no hope. Some of them, there is nothing redeeming about the building or the location. No amount of lipstick is going to make it work. And it's just a slow bleed out.
You talked about how the environment for both ends of the transaction have changed at this point, and I'm curious. A year ago, it seemed like there were a lot of CRE financiers who were willing to extend. Sort of push out loan payments rather than have a tenant leave a lease agreement entirely. And I think the thinking here was, well, if we can postpone the distress and give a lot of these tenants some breathing room, it's better than having no tenant at all or just a completely failed payment. Are you still seeing that, or do you think the dust has settled enough where people on both sides of these transactions feel like they know how to approach it differently and there's just a different equilibrium?
I think there's definitely still a good bit of what we like to call pretend and extend, for sure. There are some of these assets have gone to special servicers. They've been taken away from the operator. But there's also, for as many as have gone back to the bank, and look, ultimately the bank doesn't want these. What is the bank going to do with them? How are they going to run this better than an actual real estate owner? So as there are just as many that have gone to a special servicer that have restructured the loan and extended for 24 to 36 months.
I want to move on a little bit to what you would call the post-pandemic work life and how it's changing the environment for CRE. So, in this environment where people are working from home a bit more, or at least not going into high-rise office buildings as much as before the pandemic, there is a natural desire to repurpose those previous workspaces into more housing. We have these issues running in parallel where the descriptions that you had of the office building in the suburbs surrounded by a parking lot that doesn't really seem to have present value. We have that running parallel with housing is increasingly unaffordable. Renting, owning, all of that. And so there is a natural solution there to repurpose the office buildings to make them residential. And of course, this transition doesn't happen immediately, but have we seen much progress in that repurposing the last few years, or are real estate developers, real estate owners hesitant to make that transition if they're still not sure what kind of the next 10 or so years look like?
I think that it's a much more complicated execution to just take office buildings that don't work anymore and turn them into high-rise residential. One of the reasons has to do with the way that office buildings are designed. There is the floor plates of modern office buildings are typically a problem. You know, you get a 25,000 foot floor plate, that's very deep on each side. And if you think about a residence, right, how does everyone get a window? Unless each apartment is just one long, skinny rectangle like hallway. Otherwise, you just have people that are on the interior with no natural light. That doesn't work. So first of all, to make this work, you need a building that has a smaller floor plate. Let's call it between 10 to 15,000 square feet. Okay, so that already cuts out a decent portion of the office population, right? It has to come from a certain era in which those floor plates were much more common. Those floor plates are not common anymore. They're typically much bigger. So that's number one. Number two is you have to get the right developer with the right capital stack that has expertise in this type of conversion. And number three, you have to get it financed. Deals are just harder to come by these days because there's only so many levers you can pull on. You have the rent that you could charge the ultimate tenant, you've got your cost of capital, and you have your cost of construction to renovate the building. Well, construction costs have increased, cost of capital has increased. And so whether or not this actually pencils often largely depends on the rent growth of a specific market. And so it's not as easy as just saying, oh, there's the building, let's convert it. Well, is the deal actually fundable? Because real estate developers are not in the charity business. And if their cost of capital is too high and their cost of renovation construction is too high, they have to be able to pro forma a certain rent to make a return. And if that market can't support those rents, there's no reason to do the deal. And so there's so many external factors that come into it. It's not just as easy as let's take an office building and change it. It's way more complicated than that. And there's a lot of hindrances to whether that deal actually happens or not.
That is interesting, and I guess unfortunate that even though we have this misalignment between lower office building valuations and higher prices for residential, it's still not enough of a misalignment to really give developers that confidence to repurpose, especially when borrowing costs are still so high. Now, I think a part of the new post-pandemic work environment is not that people necessarily need to work from home. I think they just really don't want to make those long commutes, but there's still a desire for getting out of the house, interacting with other people, maybe having someone else make the coffee for you. And I feel like this creates an opportunity for shared workspaces to have another boom. Do you see any increasing popularity here, or are companies hesitant to invest after that bubble burst that we saw early on in the pandemic?
We rarely, if ever, have a conversation about remote work anymore. You know, we rarely, if ever, have the conversation about should I have an office or not. Everyone who's going to have an office typically has an office. Like if you were going to get rid of your office at this point and your team just didn't need it, you probably would have done so, right? So anyone who's in the market is typically a real estate occupier. And the question is, what kind of office should I have? And that is a much more pressing and relevant question. The occupiers of space, those that were responsible for not the majority, but certainly the plurality of leasing has definitely changed. So, technology companies really led the way for new leasing activity in the later part of the last decade. That is certainly not the case anymore, partially because they've embraced hybrid the most out of anyone, but also just because VC funding is not what it was. Hiring is not what it was, right? Those people have just not expanded headcount the same way that they were last decade. So legal, financial services, professional services, architecture and engineering, insurance, more traditional industries have been the ones that have been kind of leading the charge. And from the executives that we talk to, most of them are a 3-day in office, 2-day out of office at a minimum, right? We've actually seen in Atlanta a couple of companies, UPS and NCR specifically, come back and say 5 days in the workplace. That's an extreme that most aren't doing. So we're at the point where most clients and users of space are off the sidelines, right? Like things have shaken out. It's been 4 years. Decisions are happening. Deals are happening. In terms of shared workspaces, I think that two things can be true at the same time. Shared workspaces prove to be a real benefit and fill a need for some portion of white collar workers. There was also probably too many of them came online in the past couple of years. So there's absolutely a place for your WeWorks and Industriouses of the world. I just don't think that you're going to come and see them come online at the same clip as they were.
You bring up an interesting point about the different types of companies that might be at this point requiring all 5 days back in the office versus some sort of hybrid. And do you get a sense then about whether that divergence between different industries is, I don't know, maybe management just having some traditional sense of the value of an office work environment, or have they really realized whether their company can function totally remotely? I mean, when I talk to my peers and just kind of reading around different plans for that return to office, I can't tell if it's bosses that have been working for decades and feel like, oh no, we've got to go back to the office. That's how it's always been. Or have there been calculated decisions that say, we really know that this collaborative environment, the proverbial water cooler conversations, are really important to our company? So is it stubbornness, or is it actually that there are different productivity gains from collaboration across industries?
You bring up a really interesting point. The answer is both, right? Now, it hasn't been stated like this, but yes, we absolutely have people we work with where it's very clear that this is the way that I've done it. This is the way it's always been done. This is the way that we're doing it. And we have other people where these are, I would say, younger companies, maybe more mid-market companies, those that are building a team, building a culture, that know that part of that, a big part of that, is proximity and team and being around one another. And so there's absolutely those where it is intentional and they see the difference. And there are those where it is maybe just about, this is what tradition is and this is what we're doing. There's just no one size fits all, I guess, is how to portray it. I think the only certainty that I've gleaned from the past couple of years is that for the most part, the 5-day in office work week is dead. And it is not coming back anytime soon, save for a couple of very unique examples.
I want to put that into some greater context, though, because a lot of times I think when these stories were written about work from home, hybrid work, all of that throughout the pandemic, it was really focused on a certain type of white collar work. But if you are in manufacturing, if you work at a hospital, there are just a lot of jobs that we have in the economy that can't be done remotely. And so when you say that the 5-day in-office work week is dead, is it really just for laptop jobs that can be done entirely over the computer or phone?
Okay, let's clarify dead, right? For the majority of companies, I have some manufacturing clients where it could be a white collar job, but you got to be there to do it. And so I just don't think that the norm, the same way that I saw my dad leave home every day and come back at 7 o'clock every single day without fail. That is just not going to be the norm that most people either grow up with or experience themselves. That is absolutely not to say that there are not still a decent number of jobs and companies, and maybe it's a plurality, albeit a minority, but still a plurality, that are coming in 5 days a week. It is a cultural change from how I think most of us grew up seeing our parents go to work and how most of us used the office up until 4 years ago.
I think it is true. If one were to start a company today, it seems that you just expand your available labor pool of talented workers and just the overall office morale if you can incorporate some sort of hybrid work into it. So I do see it kind of becoming an even more progressive change over time. There's a lot of attention given to the shift in how people are working. That's what we've really focused on so far. But I'm also curious to hear whether we see any big shifts in how people are buying. What do you see as the future for retail? Has the pandemic changed what people are comfortable buying online versus having the in-person experience? I've got to imagine that the pandemic has taught people that actually there's some things that I really want to shop for in person, and I'm not comfortable just going online and having it delivered to my house before I really try it out and see it in person.
Retail, I'm a little bit less qualified to comment on. What I will say is retail has been very interesting because it, I'd be curious if office goes this way. Retail, I would say maybe 10 or 15 years ago, right? The fear was that we were overbuilt and we just had way too much retail, right? And you saw that for a period of time, but what that resulted in is historic underbuilding. And that has come to create conditions in retail that is a 5% vacancy rate. It is very challenging to find the right retail space. There definitely has been, I think, a rebound from COVID of companies putting new stores, new locations. Maybe it's a smaller footprint than they would before, but understanding that there is still a place for the physical experience of browsing and that sometimes that can go hand in hand with online ordering. So I don't think that online has kind of eaten the lunch of retail in the same way that we thought it would, even just a couple of years ago.
This is changing topics a bit, but from a micro standpoint, have you seen any notable ways that the pandemic has sped up or shifted what's called prop tech, which is how CRE firms are using technology to alter their operations? And of course, there's so many different types of CRE companies, but how they are just managing in this environment where maybe their tenants are really desiring something totally different than they did 5 years ago.
I don't think COVID sped it up. I think it was already heading that way. Commercial real estate is really one of the last, large industries to be disrupted by technology. So this is a trend that was already happening well before COVID.
I know that some of your commentary focuses on transit development, and I could see the pandemic changing demand for public transit in both directions. On the one hand, people must have realized that sitting behind the wheel in traffic is much less desirable than being able to read on a train or not have a commute at all. On the other hand, if people don't have to commute as far, they might not need public transit as much. Have you seen changes in municipalities' plans for transit that stem from the post-pandemic shifts in working and living that we've been talking about?
Transit in general has been a bloodbath since COVID. It has just not recovered. In places like Atlanta, where it really wasn't a high number anyway, it's been decimated. Fare revenue is probably half of what it was. In our largest city with the best public transportation, New York, they were going to implement congestion pricing, where everyone who comes in, I think it was south of 62nd Street or something like that, had to pay a fee to come into Midtown, and they were going to use that to, one, hopefully get people on trains more than they were, but two, to raise a ton of money for the MTA, which is in badly need of upgrades. And Governor of New York ditched that plan weeks before it was supposed to come out. Right, it's a huge blow to transit funding. So transit is in a rough place. It's always been in a rough place in America. We just don't really invest in transit like our European counterparts. COVID has not done anything good for it, unfortunately.
If there are fewer riders for transit because of this post-pandemic change in how we work and live, does that just come from people moving around less, does that then naturally follow that people are driving less, which means that we spend less on road repairs? There's less traffic congestion because, of course, people are using New York subway with less frequency because they're probably not going to the office as much. But at the same time, if people aren't going into the office as much in cities with less transit, it probably means that the roads aren't depreciating as quickly.
I have a hard time giving a qualified and quantitative opinion on that, right? I mean, I can anecdotally say I think traffic is still pretty bad, but again, that really doesn't give any sort of educated opinion on, well, okay, if we're seeing 10% less traffic, does that mean that the roads are lasting longer? I really don't want to solicit conjecture on that front. It's hard for me to believe that our roads are not being used in similar ways. Maybe they're being used less on certain days. What I would be curious to know is for riders of transit that were luxury riders, like i.e. people that don't have to take transit because they don't have a vehicle. For those that were riding transit because it was more convenient and they have a car at home, I'd be very curious to know of those, are they now driving because it's just easier and they got in the habit during COVID, or are they simply not leaving the house? That's unfortunately an answer that I don't have a question that I don't have an answer to.
Yeah, very fair. I kind of want to end with a pretty broad question, which is, we've talked about the pandemic has changed how people work and live, but I also think we've all gained our own clarity for what we value more. So maybe a lot of people realize that they really like walkability. They want to be closer to the outdoors, or they don't really take advantage of certain amenities that are in big cities. In this post-pandemic environment, what sorts of cities do you think we will really see thrive in terms of size, cultural amenities, weather, transit availability, natural surroundings? Because, of course, there was so much pressure sometimes, and I say this as someone who moved to New York 10 years ago. I really wanted to be where all the hubbub was, and then suddenly you reach a point, well, I have at least, where being around all of that hubbub is not as important as being able to take a walk in peace and quiet. And this has to mean that maybe mid-sized cities are going to flourish more than they were before the pandemic. I don't know. Do you have any sense of how people are shifting their priorities in these ways?
I can mostly comment on regions and states. I hesitate to come to any conclusions of big city versus little city, or, Rust Belt, mid-sized market that maybe gets a resurgence. I can talk about the states and the regions that, from a just data perspective, have seen the most growth in recent years. And it really is a story of the Southeast and kind of these smile states, the Sun Belt, if you will. The states that receive the most new people are probably what you might expect: Arizona, Texas, Florida, Georgia, North Carolina, South Carolina, Tennessee. And no surprise, of the 1.6 million new people that this country gained last year, 1.4 of them ended up in the Southeast. So I don't think that trend is reversing. The states that saw the most outmigration were California, Chicago, and New York. I could make more of a case for probably Illinois and California than maybe New York in terms of outmigration in the future. The story of the last couple of years has really been the resurgence of the South and the Southeast. I think what you're going to see is a continuation of that, because a lot of sort of this reshoring of manufacturing jobs and solar panels and chip production that has taken hold and is being funded partially by the Inflation Reduction Act. A lot of that is happening in the southern states: Tennessee, South Carolina, and Georgia. And so I think you're just going to continue to see that trend.
Joey Kline, thank you for coming on the podcast.
Well, it was really good to talk to you. Thanks for having me.
That was Joey Kline, Executive Vice President at Jones Lang LaSalle. One thing I take away from that conversation is how the panic over CRE that started about 18 months ago is having a long-lasting impact on how buyers and sellers are approaching transactions. Even though it looks like commercial real estate has managed to avoid the worst possible scenarios people predicted last year, the fears of instability have encouraged more due diligence and potentially even risk aversion on the part of lenders. The July CPI next week could provide the Fed with the final piece of greater confidence it's looking for in order to start cutting rates next month. Although the Fed will also see the August CPI before its September meeting, there's a good possibility that it will use its power forward guidance to start easing financial conditions before formally cutting rates at its next meeting. Chair Powell's appearance at the Jackson Hole Symposium in 2 weeks provides a natural opportunity for the Fed to start priming markets for future policy easing. Also next week, retail sales for July will give the first month of consumer spending data for the third quarter. Second quarter GDP growth was solid and June retail spending increased at a decent clip, but market participants continue to dwell on lingering recession fears, especially after last week's rise in the unemployment rate. A handful of Fed officials are scheduled to speak the next 2 weeks in addition to Powell's speech in Jackson Hole. We expect the number of those appearances to increase as time goes on, particularly if upcoming data provide an impetus to change policy expectations. That's all for today's episode. Thanks again for listening. I'm Will Compernell, macro strategist with FHN Financial. This episode was edited by Bill Stanfield. Don't forget to like and subscribe to Simply Put wherever you get your podcasts. Email simplyput@fhnfinancial.com with any questions or comments. This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. Views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.